Thank you all for joining. I'll be starting off with a review of market performance and some of the drivers there before going through fund performance and finishing off with a bit of outlook. The markets had a strong second quarter. The Nasdaq in particular had its best first half since 1983 and exited the longest bear market since 2008. And that was all despite a banking crisis, the threat of US government default, and persistent inflation. The main reason for the strength, I think, was that the worst case scenarios failed to materialize. Most notably, the recession that economists had anticipated hasn't yet played out. The Fed has continued to raise rates, but that hasn't ended economic expansion, and the labor market has continued to add jobs during that period. That said, market gains don't tell the whole story. The stock market movements have been incredibly narrow, and the 7 largest stocks, collectively named the Magnificent Seven, were up between 40% and 180%, while the remaining 493 were in aggregate flat. And it was really the tech stocks that the market thinks will benefit most from artificial intelligence that were really strong during that period. The strongest beneficiary of that AI narrative was NVIDIA. And the chart on the right shows the dramatic outperformance of that stock versus the S&P 500. NVIDIA makes graphic chips that dominate the AI market due to their high performance. And the company reported guidance which beat expectations by a huge 50%. The share price rally took NVIDIA to a weight of more than 7% in the Nasdaq, which is now conducting a special rebalancing to bring the weight of stocks over 4.5% below the 48% threshold. And that's only the third time that that's ever happened. So where are we with AI? I think the perception is that AI is this emerging all-powerful force. And that's in part underpinned by the rapid transition of technology like ChatGPT into the mainstream. But AI is a pretty fuzzy term. And I think in some ways, the catch-all nature of it contributes to the hype because it can cover such a wide range of things. A lot of AI is actually quite mundane. Machine learning is already quite mainstream when it comes to predictive text and image recognition, for example. But there is a growing focus on the potential for predictive technologies to shift from narrow tasks to addressing more complex challenges, things like drug development and even climate change. And that's really the first part of the hype. The more extreme element comes from the idea that AI capabilities will outgrow their creators and bring to life the types of science fiction disaster scenarios we've read about and seen in films, and the end of humanity as we know it. But just as there is nuance to the term, I think there's nuance to the outlook for AI. It is a technology that's growing exponentially in a broad range of areas, and companies like NVIDIA will benefit from that. However, the evidence for a successful shift from the application of AI from narrow tasks to solving those more complex problems is mixed at best. So I think that aspect of the hype is really far from imminent. AI is a real technology with real benefits, but there's a lot of exaggeration and hyperbole thrown in there as well. And because of that, we think there's quite a good chance that at least some elements of AI will follow that well-trodden path of hype, followed by disillusionment before we eventually get to the slope of enlightenment. And we think that the share price moves of companies behind that will also not be linear from here either. The other driver of market performance that continued to make headlines was inflation. This quarter, those headlines were a little bit more star-studded than usual, as Beyonce and Taylor Swift made cameos with ticket sales for their global tours. But overall, inflation has eased a bit. In the US, it's fallen to 4%, having reached double digits last year. But it does still remain higher than central bank targets, and core inflation is proving to be stubborn. In the UK, core price inflation is still around 7%, and in the EU, it exceeds 5%. In June, the US Federal Reserve held rates steady, but there was a sting in the tail to the message. It signaled 2 further increases this year, when markets were expecting only 1. And I think the key contention is really whether or not we go into a recession in the second half. And this is where central banks are treading quite a fine line. Some economists estimate that unemployment would need to go to 6.5% to bring inflation back in line with the 2% target. Others believe we can navigate more of a soft landing, so that Goldilocks scenario of the economy holding up, but inflation normalizing. And we'll come back to that a little bit in the outlook. Moving from macro to performance of the portfolio, the first slide we've got puts performance in a longer term context. And on a 12-month basis, we've lagged the broader index, but kept up more closely with global peers. Over the longer term, you can still see the significant impact of the growth to value rotation that we saw in 2022. Looking at the second quarter more specifically, the strategy underperformed the MSCI World Index quite meaningfully. And the majority of that you can see in the chart came from a weak April. After a strong first quarter, some of our semiconductor and clean energy names experienced a bit of a pullback in their share prices. We also failed to keep pace with the subsequent market rally, and that was due to a lack of exposure to those magnificent seven, which accounted for the bulk of the gains. I think it's worth pausing there for a quick reminder on our process and why we don't invest in those stocks. Our focus is on companies whose products and services address global sustainability challenges. And while those magnificent seven are quite widely held in more traditional ESG funds, none of them, with the exception of Tesla, meet our criteria for sustainability solutions. We think that creates a really differentiated portfolio proposition with strong structural growth drivers, but it can result in performance that's quite different from the index and for more mainstream ESG strategies in the short term. From the theme perspective, health was the most significant detractor. The sector was impacted by negative sentiment around inventory destocking and also biotech funding, which I'll come back to a little bit later on with regards to some company specifics. And as I touched on in the previous slide, clean energy also had a more challenging period, and that's in part due to concerns about the pace of growth, particularly in solar in 2023. The resource efficiency and environmental services themes both had multiple headwinds. Consumer demand sentiment weighed on companies in the semiconductor space, as well as some of our materials companies like DSM and Croda. Weakness in industrial production weighed on some of the more industrial names like Spirax-Sarco. On the other side, water management and the safety themes both performed strongly, and the next two slides cover the stocks behind that. The first of those is advanced drainage, which was the strongest performer within the water theme. Advanced drainage is a leading player in water management with a focus on high-performance plastic pipes. The company benefits from a long-term shift away from concrete pipes towards plastic, which is not only more sustainable, but also represents a compelling value proposition for customers. And that's largely because of the lower cost of installation. That differential allows advanced drainage to charge a premium. And as concrete prices have been increasing, which you can see in the chart on the right-hand side, advanced drainage have also been able to raise their prices. And historically, the company's been able to hold on to those price increases, even when concrete prices normalize. So there's a tailwind for margins from that as well. As well as the material substitution trend, advanced drainage is benefiting from an increasing focus on climate mitigation, because its stormwater solutions help address the challenge of rising costs from climate-related events. The map on the left gives an indication of the number of billion-dollar weather events in the US so far this year. And that's an ever-increasing trend, which is a structural tailwind for the company. MSA Safety was the strongest performer within the safety theme. The company sells safety equipment to high-risk industries, including firefighting kit, gas detection, and PPE for the industrial sectors. The breadth of MSA's end markets has enabled them to demonstrate resilient organic growth, despite the cyclical nature of some of those customer segments. During the quarter, the company announced results which strongly beat expectations, and the chart on the left shows the more recent pickup in organic growth. MSA benefited in particular from significant new contract wins, including a new deal for firefighter equipment with the London Fire Brigade. I've touched on the health theme already, but just to sort of reiterate, a lot of the themes that were driving Agilent, which was the weakest performer within the theme, were similar across some of our other holdings. So there's been an element of inventory destocking as supply chains have eased. A lot of these companies also had very strong revenue growth during the COVID period, so there's a difficult comparison effect as well. And then since the collapse of banks like SVB, there has been some concern around biotech funding, and all of those have weighed on sentiment towards these life sciences and tools companies. The chart on the left shows the slowdown in growth for the segment, which is pharma and biotech for Agilent in particular. The early expectation was that that slowdown would be limited to biotech, which is more exposed to changes in the funding environment. This quarter, however, we saw some signs that that weakness was spreading to the more medium-sized and even larger pharma companies. And so that raised questions for the market about company guidance and consensus estimates across these names, because that wasn't yet fully taking into account the spread of that weakness across the broader industry. Despite the short-term headwinds, we remain confident in the structural opportunities for the life sciences and tools companies. There's a shift towards more complex drug modalities, there's growth in genome sequencing, and there's also a broadening opportunity set in industrial and semiconductor industries, all of which support above-market growth in the long term for Agilent. The clean energy theme underperformed, as I mentioned, because of some uncertainty about the pace of growth in 2023, and that was particularly strong in the solar segment, and it was felt in both US and Europe. First Solar, which makes solar panels, was one of the weakest of our solar exposed names. In large part, that was really just a pullback after a very strong run in the shares, and it was one of the best performers in the previous quarter. One of the catalysts for that pullback was the results announcement, where the company missed on revenue, largely due to a timing issue with module sales. The company did reiterate its full year guidance, indicating that growth would just be second half weighted. Other key metrics that we look at were all trending in the right direction, most importantly, average selling prices. First Solar has sold out of capacity until 2026, and it's already secured contracts for 40% of capacity for the next couple of years after that. And as the image on this slide shows, they're really investing behind being able to meet that growing demand for solar in the US. I think one of the additional concerns in the quarter was the question of whether they would have to raise equity to fund that capacity. But the company recently announced a revolving loan facility, which should support that growth trajectory. This week, actually, the company also just announced a 5 gigawatt contract that runs from 2026 to 2030, which we think is another strong indication of how long the growth runway is for First Solar. Resource efficiency was another source of weakness among the themes, and within that, Spirax-Sarco was the largest negative contributor. Spirax sells products which are used in industrial heat processes and has a wide range of end markets, including food and beverage, manufacturing, and health. Given the industrial nature of the business, there is a degree of cyclicality that's linked to industrial production growth. And that number has been trending downwards due to a weaker demand environment. However, as the chart on the left shows, Spirax has consistently outperformed IP growth. One of the reasons that we continue to have confidence that they will do so in the future is the strong portfolio of products that they have that relate to efficiency and decarbonization. The image on the right shows their target zero range, which is specifically aimed at decarbonizing heat processes, which are considered hard to abate and rely heavily on fossil fuels. Spirax has a unique range of solutions, and it's continuing to invest in growing those. And that includes a recent acquisition that they did of a really interesting solar-based technology for industrial heat. So that covers the main thematic and stock drivers of performance. So now I'll talk a little bit about our outlook. And I think it's fair to say that the outlook for the rest of the year remains fairly uncertain. And there are a number of moving parts to that. One of the big ones is China. The pace of COVID recovery in China will be a key influence on global growth for the rest of this year. And it's starting to look likely that that will require some government stimulus if China wants to meet the 5% growth target that it has for this year. Recent data has been pretty disappointing. Growth in the first quarter was weaker than expected, exports have slumped, and youth unemployment is at record highs. So this is probably an element we see as potentially a risk to the downside. The other big question mark is the direction of US and European economies. And there's really two sides to that. On the employment side, things actually look pretty robust. Wages are still increasing and jobs are being added. So at the moment, there's no obvious signs of an earnings recession. And the chart on the left shows how low the unemployment rate, particularly in the US, is. On the other hand, industrial production growth has already slowed. And the chart on the right shows how forecasts for 2023 declined quite sharply in the quarter. And that was one of the things that fed into the weakness in some of our industrial names that I touched on earlier. I think the big unknown is the extent to which interest rates will start to affect unemployment. History would tell us it's very difficult for the Fed to reduce inflation without unemployment increasing. So as a result, there's clearly a risk that consumer demand could slow in the next 6 to 12 months. However, we've already seen the market taking that into account for consumer-facing companies. And I touched on some of those earlier. But I think the question is really whether the market is under or overestimating the impact. Hopefully, on a more positive note, I'd like to go back to the AI theme that we touched on in the first section and how it interacts with sustainability. We won't go into the question of whether it means the end of the human race here, but what I can talk about is how predictive technologies can contribute positively to addressing sustainability challenges. And I think importantly, these are real-world examples that companies we invest in are already using. We've really tried to block out the noise and the hype and really focus on what's happening on the ground. In the healthcare space, it's already been widely used in life sciences and research to speed up drug discovery, but also to identify better targets. That lowers the overall cost of the drug discovery process by screening out essentially more of the duds earlier. Danaher is one example within the portfolio that is already using AI technology. It's also being used by ICON in the clinical trial process, and that's a huge component of drug development cost. One example in this space would be technology that helps identify the right patients for trials. And that's important because recruitment of patients is actually quite an expensive component of running a clinical trial. And getting the right ones can also contribute to the strength of the evidence that comes out of the trial. A number of companies are also using predictive software to support solutions for decarbonisation. And Trimble is an example of that within the portfolio. And similarly, it can be used to support more efficient water usage. And Xylem is an example of that. The final example on the slide is HelloFresh, which is applying AI to user experience. Predicting customer behavior and what orders they're going to place is a really key tool for HelloFresh in supply chain planning when it comes to ingredient procurement. So you can see how there's a potential link to the reduction of waste if they are able to optimize that process. Hopefully, those examples give you a sense of some of the things that AI is delivering today. We do hope those capabilities expand to address more complex challenges, but we're really focusing on the reality and what's happening rather than the hype. And with that, I will pass over to Seb.
Thank you very much, Vic, and good morning, everybody. We've chosen a positive sounding title because we do feel quite positive, actually. Notwithstanding some of the things that Vic's just been talking about in terms of the challenges of the market, what feels sometimes like relentless bad news concerning environmental issues and climate change in particular. But nonetheless, we are now seeing the deployment of key low and zero carbon technologies, at speed, and we are now well into the S-curve of adoption. If you're familiar with that, the sort of slow initial pace and then the inflection and the acceleration of adoption across many of the key technologies that we think are critical to the zero carbon transition, whether that's renewables or electric cars or heat pumps. These are no longer niche technologies. They are now very much the mainstream. So we need to go faster, but overall, a relatively positive message. We are seeing real change now. The other core message in our impact report is around our impact model, which we have shared before, but has become really our sort of modus operandi, if you like, for how at WHEB we think we structure and resource our impact activities. And actually, we think that as a model, it's something that the industry as a whole can think about, and it's already becoming a bit more evident in standards and potentially regulation as well. And the core is this idea that there are two elements to impact as an asset manager. There's the what we call the enterprise impact, which is the bit that runs down the middle of that chart. So, you know, we take our clients' values and implement them, interpret them in how we then intentionally invest in companies that have a positive impact through the products and services that they sell. And we construct a portfolio of companies. We use various tools to help us do that. And these companies have a positive impact in the real world through the products and services that they sell. And we call that the enterprise impact. And I'm going to spend a bit of time just talking about some of the tools that we use and that we cover in the report. And then I'll come back to the investor contribution, which is the second piece, these two distinct elements of positive impact. So just in terms of the enterprise impact, one of the key tools for us, and which we've talked about before, is our impact engine. We've been using it now for over 3 years, but it is still quite innovative and there's a lot of interest in it. So we've included quite a bit more detail in how we apply the impact engine in practice. This slide here just shows you one of the graphics that's in the report that tries to give our clients and other readers of the report a bit more insight into how we apply the different questions. I won't go through it in detail now, but there are 6 questions, 2 each on these 3 areas, focusing on the importance of the relative importance of the outcome that you're achieving, whether that's an improvement in safety or improvement in health outcomes or environmental outcomes. So the importance of those outcomes. The second piece is around the scale of improvement in those outcomes. How much of an improvement are you seeing as a consequence of using this particular product? And the third is around the particular contribution that company is making. And we also include in the report a work example using SolarEdge, which is one of our cleaner energy investments, to show how those questions apply in practice. So we hope that's a useful additional level of detail around a key tool for us, and we think it's something that the market should be interested in as well. Another tool that we have in our report and also on the website actually is our impact map. Once you have this data, once you have the ability to assess positive impact and score it relative to one another, you can begin to plot that on a chart like we have here. So you have the positive impact on the x-axis, and then the fundamental quality, which includes an assessment of ESG on the y-axis, and you can plot each of those dots is one of our portfolio holdings. And then, of course, over time, you can see how that changes. So I've just tried to emphasize the buys and sells during 2022. So the triangles are companies that we sold, and the squares are companies that we bought. And these included companies like Intertek, which had a relatively low impact score. So I think this one down here was Intertek. Some of them, though, had a rather higher score. So LHC Group was an American business that got acquired, and so we sold that from the portfolio. But we have also added some high-scoring impact stocks as well. This is GenMab in our health theme that we bought during the year. And the consequence of this is, on average, a significant improvement in quality. So when we saw the market correct early on in 2022, we took that as an opportunity to buy some of these higher quality businesses that had become cheaper, and we were able to use that to our advantage. So you can see a significant jump in the quality of the portfolio. And in terms of impact, it's a very slight decline. It's essentially the same level of impact. It would have been higher were it not for the fact that we sold some of these. LHC was acquired, and so we had to sell that. Another one, Orpea, we sold as a consequence of some issues that business was facing. So on balance, we think a positive move, certainly in terms of quality, and over the long term, we would expect our average to be moving up towards the top right. So that's another framework that we use in the report to explain how the portfolio has changed year on year from an impact point of view. And then finally, the third tool that we obviously report on and update each year is our impact calculator. So this is measuring the positive impact that's associated with a given level of investment in the strategy, in this case, £1 million. And this is the positive impact that's associated with that. And I'm sure most of you are familiar with that tool, but if you're not, you can go onto our website, type in the amount of money you or your client has invested in the strategy, and it will generate the data for that level of investment. There are a couple of changes this year. Down here in the bottom right, we've included a new indicator, which is looking at the amount of money that is spent on research and development tools or equipment that's supplied by WHEB portfolio companies. And this is then used to develop positive impact products, typically in healthcare, but also some environmental products as well. It's a slightly different indicator. It's upstream. It's an enabler. The R&D equipment is enabling positive outcomes, but we thought it was a useful addition to the overall calculator. The other significant change is that in previous years, we've sourced the data ourselves and calculated these impact numbers ourselves. It's been peer reviewed by the Carbon Trust in previous years. This year, we've moved to use an independent third party to source that data called Net Purpose. We think ultimately it'll be good really for the quality of the data to have and for the comparability of the data as well to use third parties. So we've moved to use Net Purpose. That's just on the measurement, by the way, I should say. The impact engine itself, all that work, obviously we continue to do ourselves in-house. That's sort of proprietary to WHEB. And then the final thing just to say about the impact calculator is one of the things that our advisory committee have encouraged us to do is to try and develop our reporting of the negative impacts associated with the products and services that companies sell. So this calculator really is focused on the positive impacts. We do capture some of the negative impacts, particularly around greenhouse gas emissions. So we invest in a lot of companies that sell equipment that then uses electricity. And we capture that through our Scope 3 greenhouse gas reporting. But there are other impacts as well, and we do need to try and do a better job at capturing that information. It's difficult because companies tend not to report it, but we acknowledge that that's an area that we need to try and improve on. So that's the three tools, the impact engine, the impact map, and the impact calculator that talk about the enterprise impact. Just coming back to this model, the second part that we are very focused on is around the investor contribution, what WHEB itself can do to improve outcomes. And that's largely through the engagement we do both with companies, with clients, and also with the system as a whole, policymakers, standard setters, and others that are producing guidance for the market. And we've done a lot of work in that space as well. So just to cover a couple of points here, there's obviously much more in the report. The first piece is around carbon emissions. So this is looking at the carbon emissions from the companies themselves. We capture the positive impact of the products in terms of reducing emissions in our impact calculator. This is looking at Scope 1 and 2 emissions from the operations of the businesses that we invest in. On the left-hand side here, you have our targets around getting portfolio companies to commit to go to net zero carbon. And we achieved our first target 3 years early. So we've now launched a new target, a new set of targets, which is shown by this dotted line. And that is that 85% of our portfolio emissions, so emissions coming from the operations of the companies in the portfolio, should be covered by a carbon target by 2025. So it's 85% covered by 2025. And by 2028, it should be 100%. And you can see our progress here in green. So by the end of 2022, we were at about 80% of the portfolio of emissions from the portfolio are now covered by a net zero carbon target of 2050 or earlier. So we are seeing good progress there in terms of the targets. On the right-hand side, you've got the actual emission reductions that are being delivered. You've got our targets here in the dotted black line. So by 2030, we want to see a 50% reduction from the 2019 baseline. And then by 2050, we should be fully net zero carbon. And then you've got our financed emissions here. So this is the carbon footprint of the portfolio, if you like. And this is affected by buys and sells. And you can see this dramatic fall in 2020. That was as a result of our selling a waste to energy business called China Everbright Environment Group. That was responsible for about 70% of our carbon emissions. We don't consider waste to energy to be a solution anymore. So we sold that business, and as a consequence, we had this dramatic fall in our carbon footprint. The other line which is important here is this greeny blue line. And this is the ongoing emissions from companies held in the portfolio. So it eliminates the buys and sells. It's just the actual reductions delivered by companies that have been in the portfolio over this period. And that was a pretty good story for the first 2 years. We were delivering about a 5% reduction per year. It needs to be 7% to meet the Paris Agreement, but not too bad at 5%. Unfortunately, last year we saw a 5% increase, and that was partly due to a COVID rebound. So increased sales from companies led to increased emissions, and particularly from a small group of companies that are seeing very dramatic increase in sales. So SolarEdge, the company I mentioned earlier on, who sell components that go on the back of solar modules, they're growing extremely quickly, and they haven't decarbonized their energy supply yet. So they are seeing a dramatic increase in their emissions. In a way, we want that because we want them to sell more products, but we do need to see them decarbonize their own energy use, and that's something that we are working hard on with them. And that was the second point that I just wanted to make about this, the engagement work that we're doing with companies. This chart shows you how skewed our emissions profile is actually. These are our top 5 emitters, and together they are responsible for about 75% of our emissions. In fact, the bottom 10 emitters in the portfolio are responsible for less than 0.1%. So overwhelmingly, this is the area we need to focus on in terms of getting these companies to reduce their emissions. And we've done a pretty good job, I would say, so far in getting them to commit to reduce their emissions. So Linde, for example, which on its own, it's an industrial gases company, on its own, nearly a third of our emissions come from Linde. They now have a net zero carbon target, and it's been validated by the Science Based Targets Initiative. And that was done at our request, not just us, other investors as well. But we think we've had a significant role in pushing that company to set that target, a robust target. The other company that's interesting here is J.B. Hunt. They haven't set any emission targets yet. They are very serious about climate change. There's no question that they really are applying their brains to the issue. Their challenge is that they are very dependent on their supply chain. So they run logistics services, mainly intermodal in the US, so moving freight from road to rail, but they do run a lot of trucks, and they're dependent on the truck manufacturers to come forward with electric or fuel cell trucks, zero carbon emission vehicles. And so far they haven't done that, but we are seeing that change literally in the last sort of 6 to 9 months. We've seen some of the truck OEMs, including Tesla, bring forward their technology in this area. So we hope that will change in the next couple of years, and we can get J.B. Hunt to commit to a net zero carbon target. And then finally, First Solar, I just thought it's interesting really that this company is on this list. This is clearly a company that's providing a solution in the form of solar modules, but solar modules do use energy in their manufacture. Solar, we have a low footprint overall, and First Solar is one of the businesses that now crops up in our top 5. They do need to do a better job at reducing their own emissions, and again, it's something that we have talked to them about a number of times, and we're hopeful that will happen. They have set a target by 2050, so we're hoping that will lead to reduced emissions, and that's true for all of our companies really. We've got these commitments in place now. We expect that to flow through into actual reductions in the next few years. And then a final couple of slides from me, and then we'll hand over to questions. I mentioned the role that we play in terms of trying to shape the operating environment that we work in. the regulations, the standards that are set around impact investing and sustainable investing. And we've done a huge amount of work here over the last year. We've been a key contributor to the Global Impact Investing Network's guidance on impact investing in listed equities. Got a nice quote from them on the slide. I think that's a really important document that really helps to set standards around what we think impact investing in listed equities should look like. We've also been working with the FCA on their sustainability disclosure requirements. We were looking forward to seeing those published in the next quarter. Now it turns out it's going to be the final quarter this year. The FCA announced yesterday, but we've worked very closely with them and with the advisory group that we're part of for the FCA. And we're also on the technical committees of the British Standards Institute, BSI. They're developing standards on sustainable finance, and we're feeding into that to try and ensure that those have high standards in terms of what they define as being sustainable and impact. So we are playing, I think, for a small business, we're playing an outsized role really in terms of how we're shaping these important regulations and standards. And then finally, on transparency, kind of more generally, we have a strong view on what transparency fund managers should provide. We provide a huge amount of transparency around what we do, what we invest in, and why. We think it's a strength of ours. You've got the impact map, the impact calculator that I've talked about. We've got 2 new reports this year, our net zero carbon report, which is just about our approach to carbon and greenhouse gas emissions. We've got our stewardship and engagement brochure, and then you've got all our other reports, the stewardship reports, the impact reports, the minutes of our advisory committee meetings, which we're having one tomorrow, so the minutes of that will come out hopefully next week. And of course, the profiles of each of the companies that we invest in. Every single company we invest in, an A4 sheet that describes what the company does and why we invest in it, as well as other information. And frankly, we think all asset managers, certainly all impact asset managers, should provide this level of detail. We think it's a bit outrageous, frankly, that a lot of managers just tell you their top 10 holdings. We think it should, everything should be disclosed in terms of their investments. As I say, certainly for impact managers, but perhaps for all asset managers should be required to disclose their full holdings. We think that would be an important step forward. So there's lots more information in the report. I'd encourage you to take a look at it, but that concludes our presentation this morning, and I'll hand back to Sarah for any questions. Thank you very much.
Great, thanks so much both. That was really interesting. Just to remind everyone, we've gotten some questions in already, so I'll get rolling with those. But also you can submit your questions in the Q&A box at the bottom of the screen. So the first couple we received, I think they are interrelated, and I think Vic did address some of it in the presentation. So it's to do with performance and looking at our benchmarks. So the first one, Vic, if we looking at the last 3 to 5 years, what have you seen as the headwinds to the portfolio? And then what do you think, what market environment do you think really benefits us and the prospects of the future that we're going to get to those markets?
Yeah, so if you look at, I think if we took a long-term performance as a line chart, which we do sometimes show as well, if you take it up to about 2022, we actually held pace with the benchmark relatively well. And that was despite not owning some of the big drivers of performance in terms of what were the FANGs, now the Magnificent Seven. And it was really the shift away from the focus on growth companies, which had done very well for probably over a decade, back towards what are called value companies, which are companies that benefit from or do well in a rising interest rate environment. So at the start of 2022, we saw very strong performance from financials and a lot of the fossil fuels companies, which we just don't have any exposure to. And that was the real gap in performance that you can see, and that's kind of persisted, if you like. We haven't gained that back. In terms of what would bring our strategy or our style back into favor, I think really what we've seen over the period since then is that when you see inflation expectations start to come back, not in the sense that you get disinflation, but just that it stops going up as much. And that subsequently means that you have a lower expectation of interest rate increases. In those sentiment environments, we tend to do pretty well, actually. And we've had some quite strong periods of outperformance. And the first quarter was one where we did outperform. And I think, today we already had, I think it was today or yesterday, we had data from the UK where inflation came in below expectations. And I think once you start to see a bit more certainty on the outlook and what that means for economic growth, you start to see markets focus back again on fundamentals. And I think that's where we should start to see performance differentiate again, because the companies that we're investing in do have those long-term structural drivers and do have the opportunity to outperform over that medium to long-term horizon once the market starts to focus again on fundamentals rather than on the short-term kind of interest rate expectations and concerns about the kind of short-term macro.
Great, thanks. I mean, and that ties into, so looking at the benchmark that we use, I mean, we do map against the MSCI World. I mean, we're a very active portfolio. There's only about a 14% overlap to that benchmark. But kind of looking at that, and I know we're using the MSCI mid-cap as well. What do you think in kind of looking at our performance versus those benchmarks? And are we considering different benchmarks? Or I know there's benchmark agnostic as well, that's a consideration.
Yeah, I mean, it's something we've spent quite a lot of time debating and considering, because I think it is very fair to say that MSCI World is not representative of our opportunity set. So from that perspective, if there was something that was more representative that you could show, this is how we as a team are picking stocks relative to our opportunity set, that would be useful as a benchmark, but that doesn't really exist. There isn't anything that is a significantly better representation of our opportunity set. So if you looked at any of the sustainability rankings, they vary quite a lot and do tend to feature some of the more kind of mainstream ESG type stocks, or they just have a very loose definition. So those aren't really representative. Mid-cap is helpful in some ways because we are more exposed to the mid-cap space. But again, I wouldn't say it's significantly better because it doesn't exclude the companies that aren't offering sustainability solutions. And I think when we look at it from a client perspective, their opportunity cost is a broader benchmark. So when clients are assessing us, they probably are comparing us to MSCI World. So I think we just have to be very clear that performance will be very different. And these are the reasons why and the scenarios we should do well. And I think if we can make that very clear, then it's still the best out of a sort of non-optimal set of benchmark solutions. And again, the idea of going benchmark, we manage the portfolio in a way where we're not looking at the weight of a stock in the benchmark. But again, even though we're maybe benchmark agnostic, clients are always going to compare your performance to something. So even if we didn't compare, clients would end up doing it, and it would most likely be MSCI World. And I think if we look at our aim and what we think this portfolio can deliver, we do think these companies should do better than a broad set of companies because of those structural growth drivers and the opportunity that they have in offering sustainability solutions. So over the long term, we do genuinely think these are businesses that should outperform. And so it's still a relevant benchmark to try and beat, even if performance drivers are very different.
Yeah, absolutely. Thanks, Vic. That's really helpful. I'll let you off the hook for the next one. Seb, looking at the impact report and the impact metrics, can you talk about kind of the net purpose data set we use to report in our 2021 impact metrics versus they've slightly differed in this report for 2022?
Yeah, so in 2021 we collected the data ourselves from the companies and then had that reviewed by the Carbon Trust. So there was some level of a significant degree of independent scrutiny of the way that we did that. But as I said, we've moved to use net purpose this year. I think in terms of the actual numbers, so there is their way of thinking is very similar to ours. So and increasingly that's becoming standardized. How you measure avoided carbon emissions is becoming increasingly, there's not yet a standard, but there are lots of guidance documents out there that really tell you how you should do that. So it is becoming more standardized. One of the things that Net Purpose do, which is different from us, so we were collecting the data from the companies themselves, and we needed to see some level of assurance or methodology in order to take those data points into our process. Carbon Trust wouldn't let us just take data that didn't have some level of methodological foundation. Net Purpose, though, actually tend not to use reported data because they don't feel comfortable that that's comparable. So they had their own models that they use to calculate the positive impact associated with different products. We think it's pretty good, they will use reported data where it meets their standards in terms of the quality of the methodology, but there are relatively few companies that do that. So we think probably on balance, this is a better approach. It will drive higher standards, and as I said, will be comparable across managers, people using that same platform. There aren't huge differences year on year. They tended to net off against what, one company might have had a slightly lower impact compared to what we had last year, and the reverse will be true for different companies. So they tended to net themselves off, and there wasn't that much difference. We did go back and look at our data last year as well, and compared the Net Purpose data with ours, and it was broadly equivalent. But going forward, our plan is to continue to use Net Purpose data.
Okay, great. And kind of keeping on that tact, in terms of the progress we make from year to year in the impact report. So, it's great strides every year, and seeing how we're increasing the reporting and how we're looking at the portfolio. What do you hope to see next year as we go into the impact report for 2023?
Yeah, I think this is my 7th, I think, my 7th impact report.
But you're not counting.
I must have done more impact reports than anybody else. But it's still, I still find it quite exciting. There's so much change happening. I think for us, we've definitely settled on this model, this idea that you can have an impact through the companies that you invest in, and then you have an impact yourself through the engagement you do. I think that's a very powerful way of thinking about impact. I hope that's the way that regulators will begin to regulate it as well. And we can see improvements all over the place. I think engagement is becoming much more granular. People are really looking for actual outcomes. It's not how many times you've engaged with the company. People don't care about that anymore. They want to see, well, what's the change that happened at the end? And that's definitely the way that we're going as well. That's what we care about. So much better reporting around that. I really want those carbon emissions to come down. We've done a really good job at getting commitments from the companies, but who cares about commitments? If it doesn't lead to actual carbon reductions, it doesn't matter. So I really want to see that little bluey green line that ticked up this year. We really need to see that come down. I hope that begins to happen next year. And then finally, I think just on that point about standardization around things like avoided emissions. We've been doing this, like I say, for 7 years, and doing it kind of, others have started to do it as well, which is great, but we now have, I think, a critical mass around the measurement of positive impact. We are seeing groups like the World Business Council for Sustainable Development publish guidelines. The G7 made a statement in Japan about the importance of measuring avoided emissions. There's real momentum around this, and that's exciting because it'll broaden out the conversation, and that's exactly broaden the movement, and that's what we want.
Yeah, absolutely. Thanks, Seb. That's all the questions we had today, so we'll end there now. What I will say, again, thanks everyone for dialing in, and you do have the opportunity to give feedback as well. I will send out a feedback link along with the slides, and there's also a feedback link on our website under the Contact Us. So we'd love to hear from you, what we're doing well, and then also what we can improve. So please feel free to get in touch and give us any feedback. Happy summer holidays to everyone. I think everyone is ready to cruise into those now. And we will be back with our Q3 in October. That feels miles away, but it probably isn't. Anyway, thank you everyone again, and see you soon. Take care.